Inflation in Nigeria, double-digit levels. Nigerians are wondering how to combat its effects. Purchasing power, real rate of return on investments, disposable income being squeezed. The list goes on. Are there any asset classes that can combat the inflationary impact? Joining us to discuss further is Oyekunle Benson, CFA, as Chartered Financial Analyst with Context Analysis. Good morning, Kunle. Thank you so much for joining us. Among the many implications of higher inflation, which has the most impact on individuals?
I would say it's the erosion of purchasing power. And that's really what inflation does to you. Now, inflation itself is not a bad thing, which is why major central banks, around the world have a target of about 2%. But it is when it is high that it becomes a problem. So a unit of your currency that you have is able to buy less goods and services as prices rise. So if you have 1,000 and inflation goes by 10%, the price of that item is likely to be, 10% higher. And if your 1,000 has not changed, then, the purchasing power of that 1,000 has automatically diminished. I get a good example, from what I hear very well of is the cost of Gary. Depending on who you speak to, they say, a paint bucket was about 500 naira, and now it's about 1,500. Now, if you add 1,000, you can't buy that anymore. So that's really what it does to the individual.
Fantastic. So, we've been talking about inflation across the world. You're in Canada. Inflation there at a 10-year high, but it's at 3.6%. What are the factors there on your side of town?
Well, inflation is at a 10-year high, 3.6. Whilst it might look low, compared to Nigeria, but, given the target of 2%, it seems high. And I think the key drivers, I think there were a number of drivers, but the big ones were transportation, shelter, and another big one is durable goods. For durable goods, it was cost of vehicles rose about 5% due to chip shortages, which you're seeing all over. For transportation is really gasoline. Gasoline on a year-on-year basis is up 43%. And then you had shelter as well, because of the pandemic and work from home, people started to realize their house was too small and started moving, out of the urban centers or downtown, into suburban areas. And that drove the house of prices. But by far, the largest impact is really the base effect. Last year, because of COVID, prices declined on a month-to-month basis. So you're seeing that base. In fact, the base accounts for about 85% of the 3.6 that you're seeing. So these other items only account for a smaller part. It's just the lower base from last year, the biggest driver.
Thank you so much. Thanks. We're talking about inflation everywhere. All right, back to Nigeria. You have some options here with respect to assets for retail investors that have performed against inflation over time. I hope you can take us through this, how these asset classes performed against inflation on an annualized basis for 10 years to 2020.
Well, for 10 years to 2020, the best performing assets was nominal bonds. That's the S&P FMDQ, based on S&P FMDQ index. The next was currency. The worst performing, which we kind of use a proxy for this, was real estate, and that's using the union rates that is listed on the exchange. So the top three basically was bonds, USD, and 12 months fixed deposits. Now, only investing in nominal bonds would have, protected inflation. Others would have only minimized, the erosion of purchasing power you would have faced. But again, it's better to have it somewhere than not anywhere. The second worst performing was savings account.
Great stuff. And I think, what's the story if we look at the 20-year performance of those asset classes for 20 years up to 2020? It looks like looks like a 12-month fixed deposit was one of the best performers.
Yes, indeed it was. Yeah, 12 months fixed deposit was one of the best performance. It didn't outperform inflation over that period. Inflation averaged about 12.5%. But what you're trying to do at least is, if you're not able to match inflation or exceed it, you want to match. You want to minimize the erosion, and so fixed deposits did well. Then equities as well, and then USD. So buying the currency. So the currency is always somewhere there in terms of preserving. And I think what is also clear again over this period is, leaving the excess cash in savings accounts, would have yielded you only 3%. So, yeah.
Great stuff. And I'm seeing even so, and this is really good here because now we're looking at 30 years up to 2020. Inflation still at 17.9%. None of the, well, it looks like equities were close here. Equities at 15.7%. That was the closest asset class. Yeah, go ahead, please.
Yeah. That's absolutely correct. Equities, did better over the 30-year period. There is some possibility of some regime change here where we're saying, we're under military rule and then we transition to democracy. So you'd realize that inflation 30 years back, it's actually higher than what we had of the last 10 and 20 years by almost 600 percentage points. Terms of the asset class, and these are the only asset classes that go that far back. So it was really equities that did well, followed by holding the currency, and again, savings account being at the bottom of that.
Yeah, so this is for viewers that are watching. The savings accounts have not been doing well. Now it gets a little ugly with this with this next chart where we look at you've done inflation adjusted returns over a set period of time. If we take a look at that, yikes! Yeah, Kunle, take us through this. Only the nominal bonds have done well. Everything else is in negative territory.
Exactly. Everything else is in negative territory. Even the currency, but it's marginal. So you lose about 80 basis points every year over the last 10 years if you converted your cash to the US dollar. But if you had invested in a bond fund that tracked the S&P FMDQ sovereign bond index, you would have had a real return of about 4.2%. Real estate is negative, but the proxy itself is a weak proxy because it's just a return. It's not as liquid. But savings account would have cost you about 9% every year, and that 9% essentially means you're losing almost half of the value of your money every 5 to 7 years, and so it's actually significant.
Indeed, it is. Let's look at. I think we got 30. Yeah, look at this now. No asset class performs well over 30 years up to now. Again, for our viewers, this is 30 years up to the year 2020 inflation-adjusted return. So, Kunle, it's goodness. Yeah, go ahead. Savings account there, 12%, 12% loss. Yeah.
Yeah. So for 30-year period, equities did the best. You're losing about 2%, in real terms over that period. So again, the point is, the best case scenario is to beat inflation, right, over the long term. If you are not able to, you want to match it as closely as you can. And that is where, all these investment options come into play, all these asset classes. So equities, currency, savings accounts, and 12 months fixed deposit. And the reason for this selection is that these are things that, the average can easily access, whether through your broker or through your asset manager or whatnot. So it's not necessarily for the sophisticated investors. The sophisticated investor might be in a better position to protect themselves. For the everyday Nigerian, I think it's definitely difficult.
Great stuff. Oyekunle Benson, CFA, Context Analysis. Thank you so much for taking us through those asset classes and how they've performed versus inflation. Very informative.